Hi, I'm Audie. Today, we're talking about sculpting certainty. We are diving into the short vertical spread, a strategy designed to turn market chaos into defined, predictable outcomes. This is the foundational tool for traders who want high probability wins and the ability to sleep well at night knowing they are safe. The vibe here is smart, structured, and strictly defined. The biggest problem with naked options is undefined risk. If the market moves against you, the worst-case scenario is a total mystery until it actually happens. Vertical spreads, however, are etched in stone. You know your maximum loss down to the penny before you ever click Place Trade. To build this blueprint, we use three sames. The same option type, either both calls or both puts, the same expiration date, and the same underlying asset. The action is simple. You sell an option closer to the current stock price at the money, or a little bit out of the money, and buy an option further away out of the money. This results in a net credit collected upfront. Think of it as an engine and an airbag. The short option is your engine. It decays faster and generates the credit that funds the trade. The long option is your airbag. While it reduces your total credit, it caps your risk and ensures you survive a market crash. There are two main variations. First, the bull put spread. You sell a put at a higher strike and buy a put at a lower strike. Your goal is for the stock to stay above that short strike. It's a neutral to bullish play, even if the stock drops slightly. As long as it stays above your floor, you win. Second, we have the bear call spread. Here, you sell a call at a lower strike and buy one at a higher strike. You want the stock to stay below the short strike. This vibe is neutral to bearish. You profit if the stock goes down, stays flat, or even creeps up a little, just not through your ceiling. The math here really is etched in stone. Your max profit is simply the credit you received. To find your max loss, take the width of the strikes and subtract that credit. For example, on a $5 wide spread where you sold it for $1.75 credit, your max risk is exactly $3.25. Even if the stock goes to zero, you cannot lose more than that $3.25. Now, let's talk about the probability pivot. If you trade closer to the money, you collect more premium but have a lower probability of success. If you go further out of the money, you collect less credit, but your probability of winning goes up significantly. Our philosophy? We don't predict the future. We trade the likelihood that the stock won't make a massive move. To decide when to play, we check the weather using IV rank IVR. The rule is to sell premium when IVR is over 30. High implied volatility means expensive options. When fear is high, you can place your strikes further away for safety and still collect a rich credit. For construction, aim for a credit target of 1/3 the width of the strikes, like collecting $2 on a $6 wide spread. If you're feeling aggressive, you can go up to 40% to offset limited adjustment options. If you collect too little, the risk-reward ratio stops making mathematical sense. The mechanics are driven by theta and volatility. Time decay. Theta is your friend. The short option decays faster than the long one, winning the tug of war. We also want volatility contraction when the IV balloon deflates. The spread becomes cheaper to buy back, which equals profit. Every trade follows three diverging paths. If the stock stays away or goes sideways, that's the win. The spread expires worthless and you keep 100% of the credit. If it hovers near your strike, that's the meh. You might need to roll for a credit or manage early. If it blows through your strikes, that's the loss. The airbag deploys. Your loss is capped and you live to trade another day. We also have the golden rule. Take the cookie, close the trade at 50% of your max profit to lock in wins and free up capital. If you hit the 21-day mark before expiration and you aren't profitable, consider rolling to the next month for a credit. And if it hits max loss, accept it. Don't throw good money after bad. A quick toll booth warning. Vertical spreads have two legs, which means double the commission costs. Don't fall into the trap of trading $1 wide spreads for pennies. Commissions will eat your edge. Stick to that 1/3 width rule to make the fees negligible. To recap this masterpiece, you get defined risk, high probability based on math, and directional flexibility. The final takeaway is this: you don't need to predict the exact price to make money. You just need to sculpt the boundaries of where the price won't go. Just remember, options involve risk and aren't for everyone, so treat this as an educational guide for your financial journey. Investing in options trading involves significant risk and are not suitable for all investors. The strategies and concepts discussed are provided for educational and informational purposes only and do not constitute financial, investment, or tax advice. Before implementing any investment approach, it is essential to consult with a qualified financial professional to ensure it aligns with your specific risk tolerance and financial goals. Past performance is not indicative of future results, and market conditions can change rapidly.